Stocks, which are also called equities, are securities that give shareholders an ownership interest in a public company. It's a real stake in the business, and if you own a majority of the shares of the business, you control how the business operates. The stock market refers to the collection of stocks that can be bought and sold by the general public on a variety of different exchanges. Public companies issue stocks so that they can fund their businesses. Investors who think the business will prosper in the future buy those stock issues. The shareholders get any dividends plus any appreciation in the price of the shares. They can also watch their investment shrink or disappear entirely if the company runs out of money. The stock market is really a kind of aftermarket, where people who own shares in the company can sell them to investors who want to buy them. This trading takes place on a stock exchange, such as the New York Stock Exchange or the London Stock Exchange. In years past, traders used to go to a physical location at the exchange's floor to trade, but now virtually all trading takes place electronically. Of course, you'll need a brokerage account before you start investing in stocks. So, here are 10 guidelines for beginners investing in the stock market. 1. Buy the right investment. Buying the right stock is so much easier said than done. Anyone can see a stock that's performed well in the past, but anticipating the performance of a stock in the future is much more difficult. If you want to succeed by investing in individual stocks, you have to be prepared to do a lot of work to analyze a company and manage the investment. Going out and buying stock in your favorite product or company isn't the right way to go about investing. Also, don't put too much faith in past performance because it's no guarantee of the future. 2. Avoid individual stocks if you're a beginner. Everyone has heard someone talk about a big stock win or a great stock pick. What they forget about is that often they are not talking about those particular investments that they also own that did very, very poorly over time. So sometimes people have an unrealistic expectation about the kind of returns that they can make in the stock market. And sometimes they confuse luck with skill. You can get lucky sometimes picking an individual stock. It's hard to be lucky over time and avoid those big downturns also. Remember, to make money consistently in individual stocks, you need to know something that the forward-looking market isn't already pricing into the stock price. Keep in mind that for every seller in the market, there's a buyer for those same shares who's equally sure they will profit. There are tons of smart people doing this for a living, and if you're a novice, the likelihood of you outperforming that is not very good. 3. Create a diversified portfolio. One of the key advantages of an index fund is that you immediately have a range of stocks in the fund and you'll own stocks in different companies across many different sectors. Diversification is important because it reduces the risk of any one stock in the portfolio hurting the overall performance very much, and that actually improves your overall returns. In contrast, if you're buying only one individual stock, you really do have all your eggs in one basket. 4. Be prepared for a downturn. The hardest issue for most people beginning to invest is stomaching a loss in their investments. And because the stock market can fluctuate, you will have losses occur from time to time. You'll have to be very tough like steel to handle these losses, or you'll be apt to buy high and sell low during a panic. As long as you diversify your portfolio, any single stock that you own shouldn't have too much of an impact on your overall return. If it does, buying individual stocks might not be the right choice for you. Even index funds will fluctuate, so you can't get rid of all of your risk, try how you might. That's why it's important to prepare yourself for downturns that could come out of nowhere. You need to ride out short-term volatility to get attractive long-term returns. In investing, you need to know that it's possible to lose money, since stocks don't have principal guarantees. The concept of market volatility can be difficult for new and even experienced investors to understand. 5. Try a stock market simulator before investing real money. One way to enter the world of investing without taking risk is to use a stock simulator. Using an online trading account with virtual currency won't put your real money at risk. You'll also be able to determine how you would react if this really were your money that you gained or lost. Also, asking yourself why you're investing can help determine if investing in stocks is for you. 6. Stay committed to your long-term portfolio. Investing should be a long-term activity, and so you should divorce yourself from the daily news cycle. By skipping the daily financial news, you'll be able to develop patience, which you'll need if you want to stay in the investing game for the long term. It's also useful to look at your portfolio infrequently, so that you don't become too unnerved or too elated. These are great tips for beginners who have yet to manage their emotions when investing. One strategy for beginners is to set up a calendar and predetermine when you'll be evaluating your portfolio. Sticking to this guideline will prevent you from selling out of a stock during some volatility or not getting the full benefit of a well-performing investment. 7. Start now. 7. Start now. Choosing the perfect opportunity to jump in and invest in the stock market typically doesn't work well. Nobody knows with 100% certainty the best time to get in. And investing is meant to be a long-term activity. There is no perfect time to start. One of the core points with investing is not just to think about it, but to get started. And start now. Because if you invest now, and often over time, that compounding is the thing that can really drive your results. If you want to invest, it's very important to actually get started and have an ongoing savings program, so that we can reach our goals over time. 8. Avoid short-term trading. Understanding whether you're investing for the long-term future or the short term can also help determine your strategy and whether you should be investing at all. Sometimes short-term investors can have unrealistic expectations about growing their money. And research shows that most short-term investors, such as day traders, lose money. You're competing against high-powered investors and well-programmed computers that may better understand the market. New investors need to be aware that buying and selling stocks frequently can get expensive. It can create taxes and other fees, even if a broker's headline trading commission is zero. If you're investing for the short term, you risk not having your money when you need it. Beginners should invest in the stock market only if they can keep the money invested for at least 3 to 5 years. Money that you need for a specific purpose in the next couple years should probably be invested in low-risk investments, such as a high-yield savings account or fixed deposits. Some brokers will pester you to buy and sell stocks frequently. Reason? The more you trade, the more commission they get. 9. Keep investing over time. It can be easy to dump your money into the market and think you're done. But those who build real wealth do so over time, by adding money to their investments. That means having a strong saving discipline and holding back some of your paycheck so that you can put it to work in the stock market. You'll be able to put more money to work and grow your wealth even faster. Investing in the stock market can be very rewarding, especially if you avoid some of the pitfalls that most new investors experience when starting out. Beginners should find an investing plan that works for them and stick to it through the good times and bad. Remember, investing in the stock market involves risks, including the potential loss of principal. Always do thorough research and invest money you can afford to lose. Start small, learn as you go, and gradually increase your investments as you gain confidence and knowledge in the stock market. That's all for today. Thanks for watching. Please like, share or comment on this video and subscribe to this channel about personal finance and investing.